registered, or in fact any registered financial analyst or advisor. So take this meeting on the contents as a educational purpose and don't base your investment on this. In fact, to be fair, even my wife and daughter don't take my investment advice seriously. So you do so at your own risk. Yeah. Before getting into that, let's see what are the planning considerations that you should take into consideration while planning an investment. This investment could be one, if you're at the beginning of your career, about your regular income, how to invest, or it is your retirement chorus and how to plan, but certain planning considerations remain same. Of course, investment decision will always be based on this factor. What is the income? Because there has to be money to be able to invest. Then we need to see the expenses. Ideally, the investment gurus say that don't see how much you need to spend and plan investment from the balance. They say you put aside your investment and then keep your expenses within the balance amount. That's a great way to do that, but not very easy from a practical point of view. A lot of us tend to do is that, okay, take the expenses, and if something is left, then we get into financial planning. Other, of course, is you need to know what are your assets, and with that, the liabilities given. Those are also factors which need to be considered. Then inflation, because when you're making investment plan, it is of course for future to hold you in good state. So if your investment is giving a return, it should always be compared with relation to inflation. What it means is, if the inflation is higher than the return that you are generating on your investments, then your money is actually reducing, not increasing. Though theoretically it may be increasing, but its value will be lesser and lesser. So always keep a pointer on inflation. Then this is something everybody talks about, and you should keep in mind: emergency planning. That is, when you're investing, then you also need to know that there may be emergencies, so certain fund has to be kept aside for that. But at the same time, I also want to bring in context here. A lot of the investment literature that we read, be it in form of books or online, it is based on Western. It is the content that is made in US and maybe European countries based on the situation there. So we can't just do a copy paste of that or take it literally and making our plans. For example, what could be emergency? One, it could be like a health related emergency. It has a big cost, so it needs to be catered for. Second emergency could be just a loss of job, loss of income. So for that, people say, okay, you keep aside 6 months, 8 months. There's no fixed formula, but some months of salary worth you keep aside so that you have that emergency of losing a job or not getting income for some period, or there is a health issue, certain money is there. But here, I also want to point out that, in our target group, most of you have pension from the government. So that's not going anywhere unless if Indian government defaults and is not paying anybody. That's a very, very unlikely scenario. So in a way, your income is not at risk. As far as health is concerned, if you have a government provided, say, health cover, then the emergency risk becomes much lesser. At the same time, it may be smarter to have a health insurance rather than perennially keeping a lot of money aside for a purpose of emergency. If you have a, say, health emergency or health insurance that can be enforced of a sufficient amount, and ideally, if you start your health insurance at an early stage, then the premium remains small, and without making a break, continue to keep that health insurance active, it will be useful. You could have a health insurance even if you have a government coverage, either through armed forces or even the civilian government provided health insurance. So if you have your health risk covered, when I say yours, it would include your families. And if your income is not at risk, then we wouldn't need too much of money for emergency planning. don't get overly, say, cautious on that front. At the same time, if these two are not there, somebody like me doesn't get a government pension or somebody doesn't have a health insurance, do keep certain fund aside for that emergency. Those are the planning considerations. Then what are the factors that go into the nature of every investment? One, risk. Every investment in whichever form carries risk. There is nothing risk-free in this world. It is just that in some risk is more and in some risk is comparatively lesser. So you shouldn't ignore the risk part of it. Whenever you're looking at investment and you're excited by the prospects, don't forget to assess the risk part of it. Returns, of course, you're making the investment for getting returns, and you look at venues where you can get higher returns, but never forget that these two are interrelated. Both are like conversely proportional. If the risk is higher, only then there is a possibility of higher return, though it's not guaranteed. Similarly, the moment you're going for higher return, you also understand that you're carrying higher risk. Liquidity. This is another aspect of investment. Oh, this. Can you just check this? Yeah, okay. Liquidity is another aspect of investment that you need to consider. That is, investment may be good, it may be giving good return, but all investments are not liquid. What that means is, a illiquid investment, you cannot plan for any emergency. For example, if you just put money in your savings bank account, then it is giving some return. That is also investment. You may be getting just 4% or 5% as interest on savings account, but then it is highly liquid. If you have a debit card, you can draw cash anytime, and a higher amount, you can get it on any bank working day. So there also you understand that liquidity is limited to working day during bank hours. So cash in hand may be completely liquid asset. Then you look at a share market, equity. Nowadays, the market works on T+2. That is, you sell a share today, then day after you'll have money in your bank. So there, from a liquidity perspective, you know that within 2-3 days you can get your money, or 2 working days you can say. Even fixed deposits, it will take 2 to 3 days for getting money into your bank account. Whereas real estate, even if it is giving good return, that is not liquid. It may have a good value, but you'll be very lucky to find a buyer within the timeline that you require. A lot of times it may get delayed, or if you're in a hurry from a liquidity perspective, then you may end up selling at a loss or not getting your full gains because it's not a liquid, not traded or not publicly known value of it. So liquidity is the important part of consideration. So here you need to map your future fund requirements with a liquid asset. If it is a long term, you do not require money immediately, then you can look at that, okay, I can, even if it is not very liquid, I will go for it because it is giving higher returns. Okay. Now then, considering these factors, which are the asset classes that you can invest in? Start with equity. That is, you can invest in shares the world over, at least in developed markets and developed countries and even developing countries. Equities are proven to be giving highest return on a sustainable basis. But here, understand that return is not like a perennially at an increasing level. What I mean is, if you put in a bank savings account or fixed deposit, the investment doesn't go down. It goes in a fixed ratio at a fixed interest every month getting added to that month after month, month after month. You can guess beforehand what will your investment be worth after say 14 months or 23 months. You can exactly know that amount. Equity doesn't work that way. You may get X return in a 5-year period or a 10-year period, but in between you would have say time where the investment or return is much higher than what you had anticipated. There will also be times where the return is much lower than what you anticipated, or it could even be at a loss. So, but as long as your stock selection is right and you have a right portfolio, in the longer term, equities will provide higher return than any other category. That said, it also carries risk. Anything that is giving higher return, without saying, even if I forget to say, remember, keep it in your mind that it will carry a higher risk. Debt in different forms. It could be like anything that you give on loan. Either you're putting money in a bank savings account or a fixed deposit, or you're buying a corporate bond. Why you would do that is corporate bond would offer a little higher interest compared to a bank. Or you go for extreme safety, you invest only in treasury bonds. All of this will come under the sector debt. There would also be some tax-free bonds like national highways or infrastructure related bonds. All of that would come under the category debt. Here, there again, liquidity may be an issue. There may be lock-in for certain kind of debt instruments. You should be clear about what exactly you're getting into. Something giving a little higher interest, does it have a flexibility? Or if you're withdrawing in between, there may be a penal cost on that. So that additional interest, what you plan to get, may end up getting lower because of that. Real estate, of course, is a lot of people's favorite investment. It should be also. But you also need to keep in mind that if you're looking at investment post-retirement, probably if you have already a house, that itself would constitute a substantial percentage of your assets, and thereby you need not pursue further real estate just for sake of it. Also, generally, real estate in our case comes in very larger packages. The values are higher. That means if you already have a house or a land or something, it may be already in terms of asset, very high percentage of your total assets. And if you want to buy more, it will consume a lot of or all of your liquid money that you have at disposal. Then you may not be able to invest anything else in any other class. It can take up the whole lot of it. Just keep that in mind. Also, if one goes by Robert Kiyosaki's book, A Cash Flow Quadrant, he very nicely explains what is to be considered asset and what is considered liability. He says anything that is giving you net cash, that only can be considered asset. For example, if you have a house or a commercial property, you're getting rent, which is more than your EMI, or there's no expense on that more than your property tax, only then it is asset. Instead, you're paying EMIs and you're not getting any income from that property, then it's not asset. Of course, in Indian context, where it's a growing market, people do tend to get a good capital appreciation over a period of time. So even if you ignore that, just keep in mind that real estate is illiquid and consumes a large part of your. So if you already have a property, then don't look further for investment in real estate. Gold. This is again a favorite investment, mostly for ladies, and in fact, which had done well for a lot of families. Gold is something which comes in emergencies for a family as a backup, and also the price of gold has been going up almost continuously forever, sometimes more or sometimes less. So the returns may be a little varying, but gold has proved to be a good investment for Indian families. But physical form of holding gold has its own limitations. If one is buying jewelry, there's a lot of wastage in that, which without saying takes away whatever returns that are visible in form of gold price. Now, of course, there is gold bonds and all, which are a much smarter investment if you're looking at gold as an investment. But if it is a say ornament or jewelry for your loved ones, then of course you can't look at it only as an investment, but it has its own charm. Nowadays, with RBI liberalizing the investment opportunities for Indians to invest outside, you can invest legally any overseas market in debt or equity or purchase a property, all of that, that is something which a lot of people are considering looking at it. Typically, this makes sense if our economy is going slow or other economies are growing faster. You may want to invest in the places where the economy is growing faster. And two, if our currency continues to depreciate, then holding a dollar or that kind of other currency which is appreciating against Indian currency, that may be profitable. Here I would caution that at this point of time, and it's likely to remain that India will be outperforming most of the major markets, in fact, most of the other economies. So you may want to reconsider that part, because there may be better returns in Indian market compared to US or Europe or anywhere else. Similarly, why does our rupee keep getting depreciated? A reason is simple. We are importing heavily the oil products, oil, gas, and all of that, which takes away a lot of foreign currency. Number two is electronics. We have been a big importer, and defense is another place where we have heavy imports. When we have these many unavoidable heavy import expenditure, naturally, whatever exports we are doing doesn't cover the whole cost of it. That's where a rupee keeps depreciating. Here, if you look at a medium term, what you might notice is that dependence on oil will be reducing with the growth of renewable energy. What that would mean is that import bill and the dollar outflow will reduce. Now, with Make in India or Atmanirbhar, we are improving our, manufacturing of electronics, especially mobile phone itself is a huge bill. Now, we have reached a high standard of domestic manufacturing, and even exports are increasing. It will take 2-3 more years for the full impact to be felt. But with that, electronics also, we may become net exporter instead of importer. What that means is still reduced dependence on dollars. And the third part, even the defense equipment, it is looking. So going forward, I think rupee will not keep sliding as it has been doing over last 50, 60, 70 years. It's little far-fetched. I'm not taking that it will happen in 1 year, 2 year, but in the medium term, definitely I see rupee strengthening against dollar. When that happens, then your overseas investment may be giving negative returns because of rupee appreciating. Just as a dollar appreciation was giving positive returns in overall overseas investment, even when there is no growth, the reverse could play out. Then nowadays there are some, why nowadays? Always there are some new investment opportunities that come up, and a lot of times they become the fad of that time. For example, now say Bitcoin and all, or a similar thing, blockchain based thing. Nobody knows for sure how they're going to pan out in the longer term, but based on your what stage of life you are in, if you're a retiree investing your retirement chorus, then stay away from such. Let that risk be taken by the youngsters if they want to. But definitely these kind of things should be avoided. I'm taking because a lot of the members in our group who are in this meeting from the form part of that retiring community. So then this may be extreme risky. A lot of times these things give disproportionately high returns, but then you need to evaluate that risk with that. Is this something that can be removed? Okay, now we'll come to the equity part of it. As these groups are about equity investment and helping each other, I just rushed through, covered at a headline level, other asset classes and investment and what goes in it, what you thought should be while planning that. Now we'll just focus that, assuming that you're making whatever other investment, but what you're looking to invest in equities, what should be the thought process behind? How should you go about investing in that? One is build your own portfolio. That logically has the minimum cost because you're not paying brokerages or maintenance fees to any mutual fund or any asset manager. That said, you also need to a skill set or understanding of the market or the knowledge to be able to pick the right portfolio. Because in the equity market, if there is one stock that is going up, there will be 10 which are not going up or even giving negative returns. So without adequate knowledge, trying to make a own portfolio is extremely dangerous from a financial perspective. If you have time and say willingness to learn and want to do that, that's the best, and go ahead and do that. Otherwise, if you don't have time or inclination or not willing to put in that effort to learn and invest wisely, then trust somebody else whose job it is to do that and pay them the fee that they charge. That could be like route your investment through mutual funds or take use of say professional financial consultants. There again, you need to be very sure about who you're going with, because not all of them operate with the same level of integrity. And there may be cases wherein you're being told to invest in something not for the purely fundamental right reasons. You need to be careful. And mutual funds is something which will have a little less of that risk. But then there are enough mutual funds which have fared very badly even in good markets, and there have been a lot of scams around that also. But relatively, this is a safer way to go through if you are not aware of the markets. Then this is another thing which is being increasingly talked about. It is simple. SIP is systematic investment plan. What this basically means is that you invest certain amount of money in a disciplined way, say every month. For example, you have a spare 20,000 rupees every month. So instead of investing one big bulk amount in one go, then what may happen is that if the prices were high that time, on your bulk investment, price of share goes down, you have a negative returns, and that hurts a big time. On the other hand, systematic investment plan, what it means is that every month you're putting ideally at a similar time of the month, equal amount of money into the shares. Then what will happen is that over a period of time, if that month the price is high, you end up buying lesser shares. If the price is low, you end up buying higher number of shares. So thereby, you would probably do better than buying in one bulk. This is also a suitable method if your income is coming in a monthly way. That is, if I have say 5 crore and I'm looking to invest, then I may not be looking at SIP and trying to say invest that 5 crore over a 5-year period. No, that's not say sensible thing to do. But if I'm getting 1 lakh rupees every month, which I have a surplus and want to invest, then a SIP may be a smarter way to do that. As such, I don't have big amount to invest in one go. And this, as a discipline, every month I invest the same amount into the selected portfolio. It may yield good results. Trading, this is best avoided by most of the people in this age category. It requires a much higher skill set than say regular investment, and also even with the highest skill set you can lose money, because there is a higher element of luck involved in this, things going right. You may have all the analysis in the world, like a charts and technical analysis, fundamental analysis and all, but then say you make profit on 10 trades and then it all could get wiped out in one wrong trade. This is a risky environment, better left to the professional. There are people who make money in that. Then there are people making money in everything. We don't need to be part of everything. You need to just keep it simple, that what is your objective, what can get you there. If you keep it that simple and don't try to do everything that somebody else is doing in the market, that will be better way to go about it. F&O, futures and options. This is a still more next level of risk compared to say trading. Again, I would say avoid, unless you are very professional about it and you're dedicating 24/7 to do that and you know what you're doing. Otherwise, it is too risky for most of us. So now let's go to, when you say portfolio building, you need to select the stocks that you want to invest in. How do you do that? How do you go about selecting stocks? or where to put money, because there may be like 5,000 odd listed companies, about 3,000 of them active. And even if you take a shorter list of very active stocks, it may be around 1,000. How do you pick that number that you want to invest in? So here I will also say a lot of people tend to invest in too many stocks. So that is, you're putting small amount of money in whole lot of them. You may end up that some of them will do well and give good returns. At the same time, some of them will lose money. So overall average will come down to very less. By over say spreading, you're spreading too thin. So when you spread too thin, you're not only reducing your risk, you're also reducing your return. There's actually no point in doing it at all. If you're planning to have 100 or 200 stocks in your portfolio, I would recommend you put your money in savings bank account. It will give you better returns compared to equity investment. Of course, you can have a lot of thrill of out of this 100 shares, something going up, something going down every day, big action, but it won't lead to any result. Ideally, like you need to have a number of shares that you can manage. When I say manage doesn't mean being able to buy and being able to sell. That you can do for any number. It is just that can you actively monitor them? It doesn't mean trading, that you need to every day do something about that stock. But in the time, can you do a thorough research of that stock, understand everything about it? And two, on an ongoing basis, follow the business, not the stock price. I'm saying follow the business. What is the company doing? What is its plans? What is the management said they will do? And what have they done in that quarter, the next quarter? Any adverse news or any positive news that come in? You don't need to act on any of it or all of it, but you need to be aware of. Otherwise, it's like putting money in an open place and then going away from there. It invariably will be lost. If you cannot monitor and follow, don't invest in stocks. And it's not a rocket science. It doesn't take a lot of time. Nowadays, with the technology, all that you need to do is put in little tags in the online feed, so that even there are even say portals like Screener and all that. In that, put a list of your stocks which you are investing in, like a watch list kind of thing. So every day, at least once in a day, you get a notification about if anything is happening in that. That is the minimum you need to do. Because you heard from a friend or from some group or some online, some recommendation, don't just go ahead and buy that. Everybody, or at least if not everybody, a lot of people who are doing that have their own vested interest in saying what they're saying. Some of them may be giving genuine advice, but there is no way you can understand the difference between who is being genuine and who is talking with a vested interest. So you'll end up risking your money. So you need to select. So you learn, you select, because in the end it's your hard-earned money, and then monitor. There are two ways to come to stock selection. One is the top-down approach and other is a bottom-up approach. When I say top-down, how it works is if typically a global fund wants to invest money, they will look at, okay, across the world, which are the top countries which will be doing well over next few years. So that is which countries to invest in. After coming to the country, then they can see which sectors are likely to do well. Then from there, look at which companies in that sectors are likely to do well, and thereby come down to the finally which stocks to invest in. The other side approach is that you put the companies through the sieve, do a fundamental research, understand which companies are doing well, which are likely to do well, then look up, okay, this company is doing extremely well, but is it in a sector that is likely to sustain over a medium term, long term? Will it do well? And safe? And is it in a country which is safe? Say a company is doing very well, brilliantly, but say that company is in Sri Lanka. You can imagine what would have happened to that stock investment. Country itself has defaulted, so your investment is risk. The same thing could happen in Pakistan. If your global fund manager will say, this company, brilliant, fantastic, this is in this sector, it is also okay, but no, I won't invest in Pakistan. Just giving an example. So that way, it is going from bottoms up. You pick a bunch of stocks and maybe filter out as you go up, leave some, and then finally come to, okay, these are the stocks I'm going to invest in. I personally believe in going top down for the simple reason that if you have to do bottoms up, you should have resources and time to research thousands of them. And then from that, pick the stocks and then keep doing that. It is a very exhaustive work. So if I was doing nothing else and only that, and probably have few analysts to assist me in the purpose, then I may go for a bottoms up. That is, I'm looking at every stock and can say that from these 5,000 stocks, these are the 10 worth investing in. As I don't have that kind of, say, time or resources, I would rather be smart in how I can get to the right stocks. I'll go top down. While doing a top down, typically you look at from a investment is also like affected by everything that happens in the world. So our economy may be doing well and everything, but if global conditions are bad, overall markets may go down. So then you may want to reduce your allocation to equity in that period of time. That is, I'm talking about fresh investment. And if it overall looks good, or from a bottom, you look that a quick recovery will happen and markets will do results. So here, geopolitical and then economic, you look at it. Here I won't spend time. In fact, I had made an audio recording and shared in the group. I'll probably after the meeting share it again for those who didn't go through that. It's a half an hour kind of audio message in which we had discussed at length the geopolitical things that are happening in the world with a, say, focus on economic impact of those happenings. At a national level also, we did discuss that, but I'll briefly cover this. We are now in 23. Next year is when the, say, general elections happen. So this is a pre-election year. So this year's budget and the political happenings this year will, say, pave the way for who is going to win elections next year. That's big. So every party, including the ruling party of BJP and NDA, as well as all opposition parties, would start in earnest effort to make their presence felt, win, and then prepare for that election. What that means is political hit will be more this year compared to previous 3 years. Next year, of course, is a battle time. So what you can expect is much more political friction. Then also we have elections in a lot of important states this year. It includes Karnataka, Madhya Pradesh, Rajasthan, Chhattisgarh, and there may be a couple of others which are missing. What this means is these elections will be treated as a semi-final before the final election which will happen next year. So there's going to be a lot of bitterness here, and then there are going to be a lot of promises being made too. They will have impact. Who is making that promise? Is that promise financially prudent? It may be popular, but is it good for the economy? These things will matter. For example, if somebody says that we come to power, we'll make power free for everybody across the country, instead of me doing it in Delhi or some other place, then it can be a financial economic disaster. It will have its say impact on the economy, and before that in the share market. Another thing is there are few things where we are in a sweet spot. This year is when India has the presidency of G20. For the first time, we can look at that 20 leaders of the 20 top countries of the world are going to be in India together. And then it's also not one-off event where only the leaders come in together. Over a period of a year, there will be more than 200 conferences, meetings where there will be representatives from these 20 countries. It could be at secretary level, it could be at ministerial level, and finally at a heads of country level. All this is going to be like a major show. World is going to be watching at India much closer than they have done in the past. Our government is also planning to use this opportunity to showcase whole India, have these meetings in different parts of the country, so that the world comes to know about not just Delhi, but every city that the government wants to showcase. This is in a way, India will look at it as an opportunity to pitch India as a ultimate investment destination. We'll be talking about climate, renewable energy, terrorism, and whole lot of other things. So it's a showtime for India. What that also means is that it's a perfect showtime for the anti-nationals also. Imagine if Donald Trump is visiting India and a high-profile event, it doesn't lead intelligence agencies to say that what would Shaheen Bagh lead to. It makes a perfect picture to have burning buses, burning cars, burning houses in the backdrop of a head of state US visiting. If our intelligence agencies didn't see that coming, they are like oxymoron. They have no intelligence in that. So you can expect that as India tries to celebrate the position of responsibility and power, there will be elements which would want to create troubles in different parts of the country, wherever these events are happening. It will make a brilliant international plus for the anti-national that they can showcase things are not right in India. There's a lot of hate and there's communal tension. There is a whole lot of things they would want to showcase, because for them, this is again the kind of opportunity which they're getting once in a lifetime. When do you get to show all this negativity in front of 20 top world countries? So do it at G20. And it's not just limited to India. These things happen when a Davos conference happens every year, previously G7 and all those, then you also have a lot of people protesting. It is just that their protests may be more peaceful. Here people may try to make it more violent, gives a bad image of India, but then that's democracy. Why I'm saying that is, we need to be aware of these things will happen. So don't make your judgment that that happened means that's bad. No, people know about it, world knows about it. Then we are also at a place where the whole world, more or less, when I say world, all the important economies are in a recession or at the cusp of recession. That includes US, European Union, China. India is the only bright spot in the world economy today, at least for the current year, which is looking at anything from 6 to 7% growth. We are at a sweet spot there. Now, okay, let's assume that, some of you investing abroad, that's fine, good for you. Now, if it comes to most of us who are looking to make investments in Indian market, we decided that then look at where to invest in Indian market. As I said, we're going top down from a country. Now we're going to the theme. Where do we invest? There may be a lot of sectors where they're doing well. For example, automobile, pharmacy, IT, we've been doing well there for many long years. But if you're talking about investing today, investing now, then we need to see what is going to do well over next 5 years, 10 years. Not what has done well in last 10 years, 20 years. What has done well in last 20 years may continue to do well over next 10 years. But disproportionate growth or much faster disruption will happen in the sectors. So I'm trying to identify which are the big opportunities for next 10 years. Again emphasizing, if automobile is not in that list, doesn't mean that automobile won't grow. It will grow exponentially. But these sectors will grow much, much faster than what an automobile will grow or what an IT sector will grow. Renewable energy, no-brainer. World over, that is a focus. Unfortunately, our government believes in this. They are not looking at it as developed countries forcing us to do this and all. It's not in our interest. No. Government realizes that renewable energy is in interest of our country, interest of our people, and it is also in the interest of humanity. So they're going fully to support that in whatever way and taken up some ambitious targets. We're talking about 500 gigawatts of renewable energy to be produced by 2030. We're just about 7 years away. We are now just about 45 or 50 gigawatts, which would have been unthinkable even 5-7 years back. So we are doing much faster than what was anticipated, and we would only be scaling up this pace. And when I say renewable, deliberately I'm using the word, I am not put it as solar. Solar is going to be about 60% of this renewable energy, but there'll also be wind, there'll also be other sources. It could be, say, hydro or nuclear or whatever other sources, or some new sources of energy that may be discovered, but it's going to be, say, big on the solar also. Electric vehicles. Here again, automobile industry, whatever it has grown to in last 100 years, needs to be replaced over next probably 10 years with a fuel efficient method, or non, say, they have to get out of using oil and burning that pollution and all of that. It could be solar, which appears now that most of it is going through electric vehicles. It may be other forms of green energy vehicles. It could be like a hydrogen vehicles, already experience happening. But now from a perspective, electric vehicles look like a best bet. And you can tweak this. If hydrogen becomes new norm, you can look at the companies. But look at this heading as a vehicles which will run on fuel or a sustainable fuel. For now, we look at it as a electric vehicle. Within this electric vehicle also, I had made this prediction 2 years back that passenger vehicle adoption will take more time, especially in a price sensitive market like India. Whereas a commercial vehicle, especially buses, will move much faster. That was the reading or expectation. That's because it's going to be driven by government spending in public transport, and that has turned out true. Now you can see that money that is being spent on electric buses is way more than the sales of electric cars, and electric cars is a much more segmented market. So that's why we'll pick players which are good in this segment. We'll come to specific companies later, but at a high level, renewable energy, electric vehicles, banks, financial, it is actually financial industry. Because when you're going from a $3 trillion to $5 trillion and then on to 10 and more, it can only happen with strong financial system. Financial institutions will grow exponentially. I personally don't prefer public sector banks. You've seen there have been disaster over last 50, 60 years. Since last 2 years, they're doing well for the simple reason that the present government is not using public sector banks to fund rogue companies, or they're not forcing them to give loan knowing that it is a scam, and also let them work on the cleaning up their balance sheets. That include creating that IBC, insolvency code, through which even the old loans, they're getting resolved, even if getting a partial payment and shutting that kind of thing. So banks are having a much more autonomy now to act against loan defaulters, and then they're acting and cleaning up the balance sheet. That is how the public sector banks prices have gone up very well. I think in 22, that must be one of the best performing sector. But I always look at it that anything that can go back to old system of what they call telebanking, that is a politician makes a phone call and bank gives a loan. If that risk is there, I'll stay away from that. When you have good private sector banks, I won't risk my money, or I won't trust government banks with that. So within that, we can pick some good banks. Other part of it is the future is going to get tech driven, even in the financial sector. So the nimble footed private banks which have a very high adoption of technology are the ones which are going to rule this sector. So that's where your investment should go to. Digital. IT, we are all aware of. IT industry has been growing in last 20 years exponentially, and a lot of people made good money in the IT stocks. That will still continue for some more time, but increasingly the growth will be faster in case of digital companies. That is, those which are not providing just a service or support functions in IT, but creating digital products, so which can be delivered on a massive scale with a minimal cost. That's going to be the future. So within tech space, look at digital companies. They may be better for your portfolio. Gas. Till now, we are having gas distributed through the cylinders, which is a old model, and more efficient way, which is adopted across the globe, is piped gas to the house, and that is being adopted. Previously, only Delhi had to start with having that Indraprastha gas supplying gas, and then now almost 300 towns have been earmarked where piped gas will be given. So you have companies like Adani Gas, which are taking up those contracts. That makes it a good sector to be in. It will grow for at least next 10 years exponentially. Make in India. Fortunately, this was a theme and some effort was put into it way before COVID. Thereby, when supply chain interruption was massive on the Chinese side, and also when people started looking at China plus one, way to go after China, we at least stood as a possible alternative. Without that preparation, India wouldn't have been even a China plus 10, India's list wouldn't have been in the list. Because we have a bad policies, bad labor laws, bad land acquisition laws. It is almost impossible to set up a manufacturing plant and run it effectively in India. That is where we would have been way down, but at least government had realized the shortcomings and was taking steps to improve. There's still some way to go, but clearly now we are on that path, especially the PLI, that is performance-linked incentives introduced in the last budget. They are working brilliantly, and manufacturing is scaling up fast. So some companies which are good in that can do. Some of the people who have been part of this discussion in the previous years may find this boring because we're going back and doing the same things. That means that we also have done the right analysis. Things don't need to change. It's not like a movie that every Friday you look for a new release and then you go to watch that. If you've done the right research and going, there's no reason why things should change in 2 years. So if you're looking for something brilliantly new and say action, then this is the time to drop off. You won't find that. There'll be a lot of consistency. At the same time, you need to be watching. If there is some change, definitely there'll be tweaking in this list, be it in the theme or the companies. Then there are some new segments that have opened up, which were not very clear even in the last year. Though we were talking about it and we even identified some names. Defense manufacturing, always there was talk about it, but then we can see serious implementation. Even within defense budget, from the purchases, certain percentage being earmarked for Make in India is big, and that will grow the sector phenomenally. We need to identify the right companies in that, and these are something which we need to have. Similarly, semiconductor, this is a massive opportunity, but which companies will lead in that? Where is the investment opportunity? That's a work in progress. Same, we are looking about hydrogen vehicles, or hydrogen power manufacturing, even say power storage, because when renewable energy grows, the power is not manufactured at an equal pace. During bright daylight, in summer, there may be more power manufactured. At night time, they may not be there. So at a grid level, how can you store power in a massive scale? So those companies will do well. Which are the companies? Don't have a list yet, but these are the sector you should be keeping an eyes wide open and studying and identifying potential opportunities there. When you're investing in stock market, what should you expect? Oh, it's easy. You expect a high return. There are a few other things what you can expect there. Volatility, that's the reality. Share prices keep moving. They may go up, go down, go sideways, but that volatility will always be there. You need to understand that and take it as part of it. It comes as a package. It doesn't happen that you buy a share and it goes up and goes up and goes up and keeps going up. No, it doesn't work that way. In a long term, it may give phenomenal returns, but even that may go down, stay flat. A lot of time, market is going up or other stocks are going up. This isn't moving. Doesn't matter. It happens. So it has a mind of its own. Volatility specifically I want to highlight now. As I said, most of the global countries, big economies are going to be in recession or a near flat growth in the current year. That means that there's going to be a lot of volatility in the market. I mean, we go to sleep night, US market may tank. Early morning, Japanese market may misbehave, or a Hong Kong and Singapore may be in a moody. By afternoon, UK markets may be having a mind of their own. All this is going to affect our stock market. So volatility is going to be higher this year compared to any of the previous years you had seen. When any of this happens, they may be logically saying that, oh, our economy is still growing at 7%. It is UK's problem or Germany's problem that they have a recession. But then this will have a sentimental value. Price can fall in sync with something else over which we may not have a direct relation also. But in this global economy, one affects the other. So that will lead to volatility. And then it may recover, but then you need to have the heart to be able to sustain there, have the patience and confidence in your investment to just hold out. When the recovery to this happens, you should still be there. As I said, price drop can be corrected by quick rebound. One classic case and example is which just 2 years back, when the first news of COVID came in, markets tanked, just crashed. It was almost like there's no tomorrow kind of thing. And then there were all kinds of doomsday players who were talking about it will take 3 years, 4 years for the market to rebound kind of thing. But I think rebound took less than 2 months. This is something which will always be there if you're watching the stock prices. So my suggestion, no need to look at the stock price multiple times in a day, or not even need to look at it in a day. But do watch the business, not the stock price. So what to do is, my favorite quote is, once you've invested, what to do? Do nothing. That is the best thing you can do. A lot of time you lose money not because you made a wrong investment, but because you tried to do something about your investment. A price is going down a little bit, you sell out of panic, or price goes up little, you say that, okay, let me book profit, you sell it. Then the stock grows up much higher, then you don't know what to do, whether you should buy at a higher price or wait for it to fall. Then it goes further up, you don't know. So all these things you all been part of, and we all have been out of that, which should be avoided. A lot of time you make more money by actually doing nothing. Watch, follow the businesses. The saying is that even Warren Buffett says you're not buying a share. Treat it that you are buying a small part of a business. You need to say, if you're buying a business, a company, it's not that you're trying to react about something that you own every time. Like you hold an apartment, or say if there is a little flooding in that area, next morning you're not going to get up and sell that house. You're going to just do nothing about it. You're going to wait and to see how bad is that flooding and what is the long-term impact. Maybe you talk to the government, talk to the counselor, find a solution. So here you don't need to do that. There's a management to do that. Follow that, but you don't do anything. Keep watching the business, that you own that business. Uska kya ho raha hai? Don't keep watching the price and get anxious. Learning is continuously required. I may be doing this session, but I am getting hardly any time to look at this thing. I mean, I did this first time in the COVID wave because there was a lockdown and there was no travel. So I had enough and more time to do more research. But now I hardly get any time. So the best advisor for you will come from your own research. For that, you need to learn how to do that. And though other friends and other sources may have information, but you should know enough at least to understand which advice to take and which to ignore. Patience. After you made the investment asset, have the patience to do nothing. Don't try to do something uh, in short-term panic. That will actually harm and take away whatever good that can come out of your investment. Those were more like a psychological or behavioral things to do and not to do. But what actually determines the share price and what drives the share price going up or down? What is it? What is the share price based on? It is not based on what it is now. Share price is always based on the expectation of what it is expected to do in future. What does this company likely to be in 5 years down the line, 10 years down the line? That is going to get reflected in the current share price. Doesn't mean that we are paying 10 years future price now, but the outlook should be clear. So if some say businesses have a high PE, that is a price to earning ratio, that is because they are expected to perform or grow faster than other companies in that same segment or other companies. That's where the PE will be higher. In some cases, you see that business is very profitable, but you can't understand why the PE is so low. It's paying dividends, high dividend yield, profit is high, every quarter making profit, but PE is low. That's because either that sector or that company future outlook is not seen to be very bright, or there's a risk around that. So though today looks very rosy, they will yield lesser. The share price will be lower there. Then of course, any prospect of a future will need to be met through delivery quarter after quarter. So doesn't mean that what you're expecting after 5 years will be reflected in this quarter, but it needs to be on that pathway. It's showing that growth, steady, but at the same time on the expected lines. That is where the quarterly outcomes and results play in. You need to see in the right direction. What is the business plan overall of the company? A lot of time it gets tweaked with the changing business environment, nothing wrong with it. But be sure that the management has a clear plans, understand what it is talking, and you are convinced about that business plan. So the next part is the important part. Not enough information is usually available about this. Two businesses with an equal performance on a fundamental level may have a hugely different valuations, because the governance is different in each. One, the governance is believed to be of a very high quality, the stock price can be higher with the same profit. Other one, with the same profit, the price can be low because management or the governance is not seen to be very high. I'll just take a personal example here. In the early days of investment, I mean, like a newbie, first time looking at things and learning new words, I had learned PE ratio. I saw that Infosys was carrying a PE of about 150 times, and then Satyam Computers then was barely at some 22, 23 PE. I thought I made a big discovery in future opportunity or a hidden value with that. Then someone who was in the market or expert by then, he mentioned the management of Satyam is not seem to be of the same quality as that of Infosys. That is how they get a higher value, this lower. So in the later events, what happened, Satyam actually went bankrupt or gone down completely because of governance issues, and it had to be rescued through government intervention. And Infosys went on to keep doing well and justified those very high valuation. That time it was around 150 plus PE. This is one simple thing that works in every asset class, or in fact on price of anything in this world: supply demand. If supply doesn't match demand, price goes up. As simple, without change in even if everything else is same. Fundamentals are same, technical is same, governance is same sector, same profitability, supply demand. If somewhere supply is more, price will come down. Supply is less, price will go up. Just a classic example here. A lot of you would wondering why such high PE multiples for Adani stocks. Two reasons. One more obvious one, or what more people think, is that they are into sunrise sectors, like they're big in, say, renewable energy, Adani Green, gas, Total Gas. They're into that power transmission and various things. That is how they're getting fantastic, say, PE multiples. True, all of it. Nothing is wrong in that. But more than that, if you observe, all the Adani Group companies, the promoter is holding something between 70% to 75%. 75% is the maximum that a promoter can hold as per the SEBI rules. So usually it may be a lot of 74.9%. Whereas most of other company promoters, most of the Tata Group companies, the promoter holding is just 30% or in that range. Even Reliance, the promoter holding is just around 50%, little over 50%. So what that means is that if Adani promoters are holding 75%, maybe fraction less than that, how much is left? Only 25% is left. Out of that, in some of the group companies, 10 to 15% is held by some FII. And if there is some domestic holding, even 2%, 3%, how much have you left in the market? Less than 10%. So what does that mean is that if somebody is wanting to invest in that, there is very limited free float stock. Because promoter is not selling, that FII invested is not selling. Domestic fund, if it is there, they are not selling. And some places it's believed that FII could be someone who is friendly to Adani's, if not, say, their own. So what that means is that they are holding on. So where is the free float if other global companies want to come in, or even retail investors start buying small quantities? There's no free float. So what does it do? Price shoots up. That's one of the factors you should be aware that leads to. While selecting, see the companies with, you may not always find company where promoter is holding 75%, but yeah, you can always find where the total equity itself is less, low capital. Then the number of shares are less, price is likely to improve. Just one of the factors like that. There would be 100 such factors that can be looked at, but this is something easy to look at, and you won't go wrong mostly in this place. That's what I just discussed about. Here I'm just coming to the specific companies which I'm recommending, and you can look at which sector or a theme that we talked about where it makes sense. Borosil Renewables manufactures glass for the, say, solar panels, thereby the monopoly as on today. Its only competition is import from China. So sometimes government is imposing duty on that, sometimes it's removing. Idea is that if we have no alternative, we need to import. But it's in a good space. It's 100% capacity is utilized, and there is a buyer for that. They're increasing capex, and through that, the capital expansion of almost 400%, 4 times in this 2 years. So now the next plant, when it is ready, that will start adding to the top line as well as bottom line. It's in a good space. They also acquired a couple of companies in Europe, in Germany, I think, which are into same space. So there also, renewable energy is global phenomenon. Everybody is investing in that. So this will continue to do well at least over next 10 years. Tata Power, I picked it for it's at a sweet spot where it is into renewable power because it's setting up renewable power station through tenders, be it solar or wind or both hybrid power plants. Then it's also into electric vehicles, as in it's setting up charging infra. So a lot of times, instead of the core sector, the subsidiaries or say, Adani uses a good word, adjacencies, they may make a lot more money. So here, electric vehicle and renewable energy both come into that. The downside of this is it's got about 30% thermal power, which will be there. That you can look at, it will be a current revenue, and in the long term that will be changed over to the renewable energy part. Olectra and JBM, these are the two major electric bus companies. Ashok Leyland and Tata Motors also make electric buses. They may even be selling more of the buses than Olectra or JBM. But why I'm picking these compared to that is the revenue of a electric bus sales in Tata Motors is minuscule. So don't get mixed up. If you're looking for an electric bus company, don't pick a company whose revenue from sale of electric buses is 1% of their turnover or less than 1%. Then it's not an electric bus company. Though they may be selling more electric buses and getting more revenue from that. Instead, you have a company whose 100% revenue or 90% revenue comes from electric bus company. That's where you need to be. They may be doing lesser number, but they'll be more profitable. This is where the stock will go up. In the finance, this is one bank I love. I think in the whole list, this is the easiest stock to bet on with a very limited downside. It got a lot of things going for it. Its CASA ratio is among the highest among the banks. I think next only to Kotak Mahindra. Then the difference between the cost of interest and what they are getting, net interest margin, NIM, that's highest in the industry. And they have one of the best technologies. If you have seen, be it on a Ola Money or a Paytm or a lot of other apps, there's always a loan offer that's coming up. In most of the cases, this is the bank which is behind that. So you may be looking for advance from Ola Money just for convenience, but then that's probably going into IDFC First Bank as a loan, a retail loan. So they have very almost negligible NPS as far as the retail loans are concerned. They had, as when they merged with IDFC and Capital First, they were legacy loans of infrastructure and corporate, which they're deliberately reducing. This is one of the few I've seen where a bank is reducing the balance sheet size by cutting down the assets, that is the loans. A loan for a bank is the asset. So that the risk is reduced. So that kind of overhauling is more or less done. It's in a sweet spot, and I expect it to keep growing at a 25-30% for next 15-20 years. It's going to be huge and almost a risk-free investment, but do keep watching. KPIT is a technology company, but interesting, it makes technologies which are for electric vehicles, driverless vehicles, the future of automobile. The sweet spot there, go for it. Happiest Minds, digital company, doing extremely well. So if Infosys and Wipro are struggling to have a 20-25% digital, this is almost 95-96% digital revenue. This will grow faster than any of the other IT companies. Likita is an infrastructure company, but I'm not a fan of infrastructure. This is a different infrastructure. It's not into roads or building highways. It is creating infrastructure for gas. If Adani or any other company or ONGC wants to lay piped connection in any city, they turn to Likita infrastructure. So they're in a sweet spot, getting increasingly bigger orders and growing. Dixon, Make in India, big story. One of the biggest success story there is say invariably the biggest Indian company into Make in India in electronics, as far as electronics is concerned. It will keep going up in the value chain also. As it grows in size, it will attract bigger partners, and it's in a good space. This again fits into that electric vehicles and a space, doing well, good opportunity. Management seems to be good. I haven't done too much study into that. It's a recent recognition, but looks very exciting. This is into water treatment. As you see, future, everybody talks about that water shortage is going to be huge. So this company recycles say sewage water or a drainage water kind of it to make it reusable. So that's big, and they're going to be low. But risk there is that revenue is from most of the finance municipal and city corporations, which are not best of the financial. So the other part is it involves capex. It involves a lot of money to set up plants, but then they get an income for a long period of time, predictably profitable. So what I've been watching this for last 2 years, but my hesitation was around how do they get funds continuously to keep increasing their capacity. I'm now say happy with the fact that they are able to raise 250 crore from ADB. ADB funding means that it is a seen as a supporting something that ADB wants to focus on. So it will be very low cost fund. If they're able to have a tap like that from a World Bank or ADB, then this is in a very sweet spot. Tejas, 5G story. They're into a core research in telecom, whole lot of patents, doing extremely well. Now it's a part of Tata's. Tata's acquired it, and so it got a bigger financial bandwidth as well as global network to grow. As India is looking to provide and also promote, say, 5G network that is not manufactured in China, it has got a great future. Avantel is another smaller part of similar line as the Tejas, research in telecom, good patents, and it's also growing as a defense manufacturing company that's preparing communication kind of equipment for the defense. So again, it's in a sweet spot there. In semiconductor, we know it's going to be big, but there are no specific companies we can invest at this point of time. When you read, say, a company like Tata's or Reliance and somebody else investing in it, they're big. Through which vehicle they will invest, what subsidiary, and so that's early. But these are two small companies which are in that space. I mean, as the sector grows, in the sentiment they may grow. Individual companies, you need to do a deeper study and understand. 3i Infotech is another digital company. We've been talking about it, but over last 2 quarters, we can see they've been able to make digital products and actually start selling. So they have a small size but sales happening of the digital products, implementation, and it's working. So as long as they have a product that's working, it's all about sales side getting increasingly bigger orders. Here, low equity, early stage, it's almost like you getting to invest in a startup stage of a IT company, but with a proven track record. So you can keep watch. You can treat it as a penny stock investment. May pay well over next 2-3 years. NDTV, for one simple reason that now Adanis have acquired and not only got their 30%, but now I think stake has come to about 65%. You all have seen what Adani Touch has done to their whole group companies, and as such, it was in a trouble. It was down. So it may be early days, but if Adani gives the same focus that given to a lot of other sectors, then this may be re-rated, and they may be looking to make it as a global Indian English channel. That's the opportunity. On the downside, even Adani said they're not looking at this as investment, but something to provide. If they look at that kind of angle, we can't be sure, but net, I would think it will be worth holding some of it. So these are very small basket. I mean, research just 20-30 from that pick this kind of thing. It's not exhaustive that in the market there may be at least 100 stocks which are better than each of these stocks. So not saying any of it wrong, just that I haven't been through that. From the list of top-down approach, from the sectors that we discuss, pick these stocks. As a recommendation, you can consider do a deeper research before putting your money. Nothing. I thank you all who joined and hope it was of use to you. Before we close, anybody wants to ask anything? Let's do that now. If you're on Zoom, you can unmute and talk. Or if you're on YouTube, you can just drop a comment. I can't see from here, so if there is something, let me know. Okay, then we'll call it a day. Thank you for patiently watching this, and I think people have better things to do on a Saturday evening than continuing to watch this. Thank you.